So let's talk about the steps. So step one is the AD table, which we're all familiar with at this point. It's always done as of the acquisition date. So it does not change. It's exactly the same way that we did it in chapter 4. So we know that our acquisition differential can be split out and due to a couple of different things, right? So we know that there can be fair value differences due to depreciable assets. We know that there can be fair value differences due to non-depreciable assets. And what is the last thing that we need that it can be due to? Goodwill. So we want to take this one step farther now and consider, now that we're not right at the date of acquisition, what do we need to consider? So for a depreciable asset, what happens year after year? Depreciation is taken. So what do we need to do? We need to take depreciation on that fair value difference. What about non-depreciable assets? When does something change for those non-depreciable assets? Think about land. So when it is sold, we would need to make an adjustment to our acquisition differential when that land or that non-depreciable asset was sold. So there would need to be an adjustment. And what kind of consideration do you think we would need to make with goodwill? Well, consider, what if goodwill is impaired? Then we would need to go ahead and consider making an adjustment to the acquisition differential, the goodwill portion of that, if there was some sort of impairment. And so that's what we're going to talk about in step 2. So let's go ahead and put this into action. So pull out example 1 out of your notes here. So we can see on July 1st, year 5, Big purchased 80% of the outstanding common shares of Little for $122,080. On that date, Little's equipment had a fair value that was $21,600, less than its carrying amount. Also on that date, Little had an exclusive 5-year contract to provide services to the provincial government. An independent business valuator indicated that a third party might pay up to $50,000 to take over this contract. All other assets and liabilities had carrying amounts equal to fair values. Using the worksheet following, consolidate Big and Little as of the date of acquisition, and then perform the journal entries. So let's start with step 1. So we need to prepare our AD table. So our first point here is to, what is the purchase price? What did they buy the shares of Little for? So they bought 80%, and they bought it for $122,080. And we're going to go ahead and we're going to highlight this in blue because we know this is going to be a balance sheet adjustment. So our next step is we need to go ahead and what is our implied price? So if we had bought 100% of the shares, what would we have paid? So our implied price for 100% of the shares is $152,600. And we get this by taking that $122,080 and dividing that by 0.8 or by 80%. Okay, so on our AD table, our next step is to look at what is the book value of the subs net assets. Oops, net assets here. And we get that by the common shares and retained earnings. So if we scroll up here, we can see that our common shares of Little are 54,000 and our retained earnings are 32,400. And so together we know that that is 86,400. And we're going to highlight the common shares value and retained earnings value in blue because again, we know that this is an adjustment on our balance sheet. So taking that implied price of $152,600 and subtracting the book value of our net assets gives us what our AD is, right? Our acquisition differential. So we have an acquisition differential of $66,200. So now this is where we need to go and split it up into what is the fair value differentials of our depreciable assets, our non-depreciable assets, and then what is our goodwill. So if we go ahead and we read the narrative here, we can see that there is a difference on the equipment. So right here, Little's equipment had a fair value that was $21,600 less than its carrying amount. So the fair value is less than the book value. We're going to go fair value differentials. And we've got our equipment. And our fair value minus our book value. So we know our fair value is less, so we're going to have a negative $21,600. And we have one more item here that is a fair value difference. There's a business valuator indicating that a third party would pay $50,000 to take over a contract. So that contract isn't actually sitting on Little's balance sheet anywhere. But when we're talking about the price, we're going to be paying for that contract, right? So it's going to contribute to a fair value difference. So we've got our government contract, and its fair value is $50,000. And the book value is 0. So if we come over here and take that $50,000 less the $21,600, we have $28,400. So we can calculate our goodwill as being that $66,200 less this $28,400. So $37,800 is our goodwill. Now just to go back and do some highlighting, we know we need to include this government contract on our balance sheet. So we're going to highlight that in blue. We also know that we need to make an adjustment to the fair value for this equipment for that $21,600. So we're going to highlight that in blue. The other adjustment we're going to need to make is goodwill. So we're going to highlight that in blue because it's going to hit our balance sheet. Next, let's go ahead and do the journal entries to record the transactions that have happened here. So again, these are not journal entries that are going to hit the parents' books or the subs' books. These are journal entries that would be on the consolidation, hitting the consolidation working papers. So the first thing we want to do is we want to eliminate our common shares and retained earnings of the sub and set up our BNCI. So if we want to eliminate the common shares and the retained earnings, what do we need to do? We need to debit it. So we're going to go ahead and we're going to debit our common shares for $54,000. So right here we can see we're debiting the common shares for $54,000. We're going to debit our retained earnings. So again, we've highlighted in blue to make it stand out that this is an adjustment that we're going to need to make. So we're going to debit our retained earnings for $32,400. How much did we have as our acquisition differential? $66,200. So we're going to set up a temporary account here. So we're going to go ahead and debit our acquisition differential, and we're going to do that for $66,200. So what are we going to credit? What did we actually buy? Well, we bought the shares. So we're going to credit our investment in Little account because we know we need to eliminate that, right? And here's our adjustment right here. This $122,080. We need to get that off of the balance sheet. And so what is missing? What's missing is our non-controlling interest. We've recorded our acquisition differential based on 100% of the net assets. So we need to take that difference between what it is that we actually bought, that 80%, and the 20% of the non-controlling interest. So we're going to go ahead and we're going to credit our BNCI for $30,520. So this is our elimination and setup of BNCI. So the next thing is we need to do our second part of the journal entry is we need to allocate out our acquisition differential. Where does the 66,200 go? So it's comprised of three different things. It's comprised of our goodwill, it's comprised of this contract, and it's comprised of this adjustment to our equipment. So we're going to debit the contract because it's an asset for that 50,000. We're going to debit the goodwill again because it's an asset for the 37,800. We're going to credit our equipment for 21,600. So we can see that right here. And we're going to credit the acquisition differential. So eliminating this temporary account that we set up. So eliminating it for 66,200. And so that is to allocate our fair value differentials. So this exercise right here, we don't actually need to go through this exercise every time. We can use the worksheet, but this is a good way to illustrate what it is that's going on when we're doing the AD table and what the purpose of it is.